Hey everyone, this is Rob Keens of goldsilverpros.com. It is Wednesday, March 3rd, 2021. It's a lot of content that we could cover, so I'm probably going to do a series of shorter videos this week. We're going to go ahead and jump right in. We're going to take a look at what's going on in the general economy, and then I'm going to take a look at the precious metals right after that. There's an interesting report that comes out from Transunion every month where they look at some industry snapshots. This is the January 2021 monthly industry snapshot. And Transunion, along with some of the other credit rating agencies, because they're ingesting so much data, can look at different industries and tell where they're going. They know how people are doing on their credit, and they also know how they're doing per industry. So this is always a good little snapshot to look at. I'm going to read just the first part of the executive summary so you get an idea of what we're looking at in this report. It says here, Transunion is pleased to release the 10th edition of our monthly industry snapshot, the first of 2021. As the new year progresses, impacts of the pandemic continue to evolve. Each month, we provide lenders with insights on consumer credit trends to help guide strategies, and some highlights include. And then I'll let you read that executive summary if you want to. You basically just go here to this URL on Transunion's website, or you can just Google it and find the report. We're going to go down and look at some of the data in the report. So I'm going to blow this up as much as I can, get it in these little snapshots into the picture. So what they do here first is they break it down by industry. So the first set of charts is for auto. Then they have their tiers here, the risk tiers here. So the current one is in the bright color. So the current risk tier is 13.83% for the subprime. And then it goes up from there, near prime, 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 prime plus, so on and so forth. But really what I want to look at is the number of accounts, or the percentage of accounts in hardship, and how that's trending since last year. It's this middle table here. So I'm going to blow this up just a little bit and focus on this middle table. So in the auto sector, January of 2020, that's a year ago, 0.453% total right here. If I can highlight just this one. Last year, not even a percent, about 0.5% of people were in some level of hardship, meaning they were delinquent on their payments or they hadn't paid in a while in the auto sector. That has now jumped to a whopping 2.66%. That is something like a 5.5-fold increase since last year. Now it has come down just a tad since December 2020, but it's still very, very high compared to a year ago before we started having the shutdowns. That's the trend that we're going to be noticing. And that's what I wanted to point out to you. That's why I looked at this particular month's report here for the channel, was to do a year-over-year trend to see where we have come since the shutdowns, basically since the pandemic began. Subprime has jumped amazing, almost 900%, from 0.928 to 8.891. That means the lowest part of the market by credit score is suffering the most in their automobiles, and it means all of those subprime automobile loans are basically starting to blow up. The near prime, which means they get an interest rate slightly worse than the prime or the best, is went from just over half a percent, about 0.6%, to almost 4%. So that one jumped a great deal as well. The prime went from 0.418 to 2. So even those prime lenders, those decent credit and above, are spiking. We saw an increase in prime plus, which is really good credit, 0.326% to 1.1. So that's almost a quadrupling. And the super prime has even gone up. It's tripled. So even the best credit, the amount of accounts in hardship owning automobiles has tripled year over year since basically we saw the pandemic. Not so surprising when we see all the deflation in the economy, the job losses, so on and so forth, but you see it really show up in automobiles. Now, as we go through the other industries in the report, you're going to notice where people are prioritizing their money, because essentially people don't have enough money, and I'll show you some of that information later on in the presentation. There's a nice little story in Zero Hedge. We're going to go over some of the savings rates and things in a moment, but it's interesting to see where people prioritize their money. Obviously, they're letting a higher percentage of automobile loans go bad, essentially, over some other areas. So let's scroll down. We're going to look at bank card or credit card, if you will. This time last year, there was 0.06 of 1%, 0.06 of 1%, not 6%, 0.06 of a single percent of bank cards in hardship or delinquency. Now there's 2.133%. I don't even know how many thousands and thousands of a percent increase that is, but it basically went from being minuscule to being over 2% of bank cards in hardship. The subprime, of course, went up the most to 2.9% from the same 0.006 or it's 6 1,000ths of a percent. Let me get this correct. 6 1,000ths of a percent. The same as the total. The subprimes went to 2.906. The near primes were 7,000ths of a percent. They went up to 1.834%. The primes are about even money on the credit, is 8,000ths of a percent, went up to about 2%. The prime plus 7,000ths of a percent to 2.2. And the super primes 4,000ths of a percent to 2.091. Now, the interesting thing to note here is, regardless of your credit level, you went from having a minuscule, almost identical from 4,000ths of a percent to 7,000ths, or 8,000ths of a percent, not that much. In other words, minuscule amount of delinquencies on bank cards and credit cards, to all of them going to about 2%, with subprime going to almost 3%. It's like an even distribution across the different credit ratings for the bank cards. So that is really exploded. So what that tells me is people may be using their bank cards more to pay for other things. We'll see that in mortgages here in a moment. Maybe to pay their auto bills, although auto bill delinquencies are exploding. They may be using them to pay for other things, and it's probably housing. Let's take a look at housing next. So mortgages. This is the percent current. So this report's done a little bit differently. It's just showing current and how many days overdue in this middle section. So we're going to look at January of last year, current 92.9%, January 2021, 95.7%. That number actually looks pretty good. January last year, 30 to 60 days overdue, 3.9% down to 2.2. 60 to 89 days overdue, 2% down to 1.2. 90 plus days overdue has dropped from 1% to 0.7, and in foreclosure is halved from 0.2% to 0.1%. So where are people spending the money? They're using their bank cards to help pay their mortgage. That's obvious, whether they're withdrawing cash or doing it in some other way, using checks written on your credit cards. They're paying off the mortgage because the amount overdue on the mortgages has actually fallen over the year, while the auto and the bank cards has exploded. So people are prioritizing their mortgages, the place where they live, over the automobiles, and they're using their credit cards to do it. This makes sense if you think about people not commuting to work as much, not going out to restaurants as much. Maybe they don't need as many automobiles. Maybe they're selling off an automobile and sticking with one instead of two, or two instead of three. And they're also letting them go more delinquent. And they're also using their bank cards basically to finance their lifestyle. That's pretty clearly what this report is showing. So interesting data there. Unsecured personal loan. Now, this is really interesting. If you go to your bank and you get an unsecured personal loan, that means that you're using, a lot of banks will use something as collateral. You can tie anything you want into it, but this is unsecured. So basically you go to your bank and you're saying, I have decent credit. I have had a bank account here for 10 years or whatever. Can you give me an unsecured personal loan? So it's just a loan the bank gives you. It tends to be a little bit higher interest rate than what you could get like on a mortgage, but lower than what you can get on a credit card. So they're going to be pretty popular, but the banks also tend to be somewhat stingy on these. They don't hand out credit on these as readily as they do credit cards. So it's kind of in between like a mortgage and a credit card. Not as much paperwork, and you don't have to put your house up for collateral on an unsecured personal loan, but a little bit harder to get than a credit card. So January 2020, last year, we had 0.223%. That's less than 1%. We're basically delinquent or in hardship, and now it's exploded to over 3%. So this is even higher than what we saw on the bank cards and the auto loans, well, except for the subprime auto loans. But essentially, people are letting these personal loans, because they're unsecured, go delinquent faster than they are even their credit cards, because they know they have to keep their credit cards. The unsecured personal loans, maybe it's an issue with the bank, but if you're out of money anyway and you don't have any money in your checking or savings account, I could see why people will let these go delinquent faster. So people are figuring out where can they basically borrow money and never pay it back, and where are the lowest amount of consequences, where are the highest amount of consequences. They're not going to lose shelter and go live on the street before they allow these personal loans to go bankrupt. They probably liquidated their bank accounts in the meantime while they let these go delinquent. Then they're giving up some of their cars, and then the mortgages are going to be next. But the trend is that eventually it's going to come to mortgages, because you see it big time in the credit cards, you see it in the automobile, and you see it in the personal loans. So getting back to the detail on unsecured personal loans, it went from 0.173% this time last year to 3.317%. Near prime, 0.228 to 3.16. You see the same level of consistent delinquency rates going up on the unsecured personal loans here as we did up in the essentially the bank cards. The percentages are basically the same regardless of your credit level. So regardless of your credit level, they were really low this time a year ago, really low, like 0.2%, exploding to between 2.5 to 4% across the board on the unsecured personal loans. So there's more information in this TransUnion report if you want to look at it. They got it broken down by state, percent of borrowers 60 plus, so they got age groups 30 plus. I encourage you guys to go look at that because it'll really teach you about, first of all, who's suffering problems, and second of all, how people allow these bankruptcies to progress, because this is all going to appear on their credit and what they value the most. Obviously, shelter service and the mortgages. They want to keep their credit cards liquid as much as possible because they live off the credit cards to pay for other things. They'll let a car go and they'll let some of those cars go delinquent, and they'll totally not pay unsecured personal loans. So what happens to banks lending out on these unsecured personal loans? When these rates get high enough, they'll stop lending those out. And that will start a cascade. Credit gets tighter as delinquencies go up pretty much across the board. So whether we're talking the personal loans, the mortgages, the autos, or the credit cards, as delinquencies go up, banks are going to, that hits the banks and their liquidity ratios. We talked about, remember, Basel III requirements are tightening up liquidity ratios this year across the board for banks. So as delinquencies go up, regardless of what category those delinquencies are, it's really more the overall dollar amount as that plays against the bank's liquidity ratio, their ability to be liquid, because you have to have more money coming in than going out to stay liquid, right? So as delinquencies rise, your liquidity ratio gets strained. And as Basel III requirements start to come into play here on the liquidity ratios this year and next, that's going to start a cascade and a waterfall of not only defaults of people on their various loans, but on the banks not lending anymore. So those two things are going to happen at the same time. Higher delinquencies, less lending, especially to the subprime borrowers. So I expect to happen, the subprime borrowers are going to get squeezed first, and they're going to lose out first, and it's going to go right up the chain, right up the stack of the credit ratings as both of these things converge. Interesting information for you guys to see, especially in light of people criticizing the states of Texas and Missouri relinquishing all of their restrictions due to the shutdowns and due to the pandemic. They're releasing the restrictions, they're getting rid of the mask mandates and things, and they're getting a lot of criticism. But I think those states, the governors of those states and the health departments may be seeing this coming, and they know they have to get the economy restarted, because this could knock out the entire system. Or at the end of the day, the end victims of this are not only the account holders or the people taking the loans, it's going to be the banks. And if the bank failures start cascading across the system, and again, it's two things happening at once. It's delinquencies going up across the board, with the exception of mortgages, but it will get there eventually to mortgages as people run out of money. As delinquencies rise across the board and the Basel III requirements start to come into play and tighten things up in the banking sector across the rest of the world, if we don't open up the economies, then you could start to see cascading defaults across the banking system, and that could start the next depression. And the Fed could print all they want, but they already have dumped with quantitative easing and all the printing going on as a result of quantitative easing, regardless of how that money gets printed and transmitted. We can talk semantics. But as you ease, as the Fed eases and more liquid money and debt money enters the system, the next subsequent round of easing that you do is less effective. So if we have another issue where we have a banking issue like we did in 2007, 2008, the economy could be in serious trouble because they don't have as much firepower. They can't lower rates. We're down basically at 0% rates. So they can't, have 5% of rates to lower like they did during the last crisis. I think they were up over 6% and they started lowering. And on average, the IMF has said you need 5 percentage points to lower to jumpstart an economy during a major recession. The Fed doesn't have that. And they've already created so much easing. So there's so much debt and money awash in the system that they would literally have to drop a nuclear bomb of money on the system to have any effect whatsoever. And even then, I think it appears as though it may not be enough. So I think that's the period we're entering into. We're the end of this round of the fiat system where it's going to crash. And we're starting to see that come across the numbers. And a lot of that had to do with the deflation economy last year due to the shutdowns and the restrictions. So criticize Texas and Missouri governors and health departments all you want. but I think they see the writing on the wall, and maybe that's one of the reasons. And along with the virus numbers going down sort of across the board, at least as reported by the CDC, whether or not you believe those, I'm just saying the officially reported numbers. I think that's why that's happening. The governors know, and the townships know, and the people know. Another piece of data I wanted to share with you is this really interesting report on Zero Hedge. It's called 30-year mortgage rates are no longer below 3%. So going back to this report, the only area where people didn't have rising delinquencies was in mortgages. But now we're already starting to see the banks react and raise mortgage rates. So in other words, the era of ultra low mortgage rates is about to come to an end. They cannot keep it low. They have to raise those rates to deal with all these other delinquencies and all the other risk in the system. And also we're seeing bond rates rise, and that's going to affect eventually the mortgage rates. There's a certain sector of the bond rates that affects mortgages are basically based off of those bond rates. So as the bond rates rise, so are the mortgage rates. And so that's going to tighten up how many people can get lending for homes. Okay. And you're going to start to have more delinquencies as people give up their automobiles and give up and can't get secured loans anymore. Basel III requirements come into place and require more liquidity. Banks tighten up. Then it's going to start to affect 30-year mortgage rates at a time when you have affect mortgage solvency at a time when you also have rising mortgage rates, meaning less mortgage loans subsequently closed, which means less liquidity coming into banks in terms of overall amount of lending, which means additional stress on the banks. You're starting to see the trend of what I'm talking about today. That's what this whole video is about today. It's about solvency of the consumer and solvency of the banks as a result of that, and some of the regulatory requirements coming down that's going to make it worse starting this year and next with Basel III. So 30-year mortgage rates are no longer below 3%. US 30-year mortgage rates have rebounded sharply since 2 weeks, with the 30-year Treasury yield spiking above 2.25%. This story was as of March 2nd, so it was earlier this week. On Thursday, last week, the recent shock to Fannie Mae 30-year mortgage used as a benchmark for U.S. home loans was meaningful on a 5-day basis outside of one time during the crisis last spring. It was the biggest percentage rise in mortgage rates on record. So here's the chart. You can see the 30-year 5-day price changes spiking, and the overall rate is now above 3%. As it goes on further to say, despite the latest report from Freddie Mac suggests that 30-year mortgage rates were still at 2.97%, it seems that reality is a little bit different. So now we have going above 3%, according to Bloomberg, Freddie Mac, and Christoph Barad. So going back to the report, earlier this week, Mortgage Daily News published an interesting article highlighting Freddie's data is accurate when it comes to capturing bond rates over time, but can really fall short when the bond market is experiencing elevated volatility. The paper added most any mortgage lender added another 1/8% to their 30-year fixed rate offerings. Over the course of the past week, most lenders are 0.25 to 0.375% higher, and compared to the beginning of last week, many lenders are a full half point higher. In other words, what had been 2.75% is now 3.25%. What had been 2.875 is now 3.375. The spike in mortgage rates has already had negative consequences. U.S. home loan purchase applications fell for the third straight week, reaching a 9-month low. 9-month low. Lending is going down, and we haven't even gotten to the meat of the liquidity requirements on Basel III, which is going to change the whole game later this year. Mortgage Bankers Association data showed that the purchase index decreased by 11.6%, the largest drop since April of 2020. And we know what happened last year around that March-April timeframe. In a weekend of February 19, 2021, down 6.1% in the week prior. So in other words, the percentage of down is going up. It was down 6.1%, now it's down 11.6%. So that is an increasing amount of reduction in the purchase index. The index of purchase application has fallen in 4 of the last 5 weeks, down 23.9% from mid-January. So since TransUnion compiled all this mortgage information and this credit performance information, the overall purchase applications have fallen 23.9%, and the rates have risen to over 3%. So you're starting to see the trend there. You're seeing the tightening. You're seeing less money come into the system. You're seeing the whole thing just start to like this. The whole machine just like oil's been drained down the engine. It's starting to seize up. You're starting to see signs. All right, another interesting report Related to all of this, again, from Zero Hedge, I love Zero Hedge because they've, in the last week, have had really great information on what's going on in the economy and what's going on with consumers. So 27% of all household income in the US now comes from the government. Following today's release of the latest personal income and spending data, Wall Street was predictably focused on the changes in these two key series, which showed a surge in personal income to be expected in the month when the 900 billion December 2020 stimulus hit, coupled with a far more modest increase in personal spending. You can see this chart. See if I can blow this up just a little bit. So there was an increase in personal income, but not so much an increase in consumptive expenditures. So people are either saving or using to pay off other debt. But while the change in the headline data was notable, what was far more remarkable was the data showing just how reliant on the US government the population has become. Personal current transfer receipts, that's a little big. Let's drop that one down. So you can see here that the personal, let me blow this up smaller because my window is going to be on top of it. Okay. This is basically government payments to the public has gone, if you look in 2000, January of 2000, at the turn of the century, it was about $1,000 per person. It's reached about 6,500, and that was during basically crisis times last year. We know the shutdowns, and then it's almost re-reached that a year later. We're sitting at about 5,700 current transfer receipts or payments from the government to the public. And it means that excluding the 2 trillion annualized surge in government transfers, personal income excluding government handouts actually declined by 22.3 billion. So in other words, if the government hadn't been handing out, personal expenditures went down 22.3 billion. Hardly a sign of a reflating economy. So you can see the numbers here. US household income minus government handouts is actually down in September, down December, or up a little bit in December, down in January. Remember, December is holiday season, but you're not seeing a huge jump due to holiday season. So this holiday season was pretty muted compared to past holiday seasons. Shown in longer term context, one can see the creeping impact of government payments shown in red below. I'm going to make this a little bit bigger for you guys. So the red is the government payments, and the rest is personal income minus the payments. So you can see over time, and this goes back to 1959, the gradual increase as an amount of the payments by the government. It's increasing. It's also increasing as a percentage. You can see this red is a larger percentage of the overall pie than it was at the very beginning. That's something we talked about in our book. In my book, Drop Shadow Truth About the Economy, which you can order on Amazon or subscribe on my website and get access to, I talked about this trend, and I use government data. It's about 50 pages in chapter 2. I talked about all this in excruciating detail. Here's another chart on the personal savings rate. Now, it did spike when the pandemic first hit because people weren't out spending, so they were saving, but that has fallen throughout the year. And personal savings rate has gone up a little bit. But again, a lot of that has to do with government expenditure. So the government doesn't continue to bail out, the personal savings rate is going to fall back off a cliff. So even though the personal savings rate momentarily went up, it did not increase the overall savings of the average American. And you can see that in the delinquency data we showed from the TransUnion report at the beginning. Now, government transfer payments as a percentage of total income, you can see it spiked. It spiked twice, spiked at the beginning of 2020, and now it's spiking again in 2021. It continues to go up. Now, it's been going up over time since they started looking at it in 1960. So this just means the government's paying more and more. And at the end, they're having to pay a whole bunch just to keep the economy going. That's essentially what this is saying, because the consumer is about 75% of the US economy. So the government has to increase transfer payments to consumers or the economy collapses, essentially. And that's what's happening. So rich countries tend to have a bigger middle class, except the United States. You can see here, here's the US compared to the trend. This is a trend line of rich countries. The US is lower, the middle class basically is dying. That's what that means. US at same level as China, Turkey, and Russia. So China, Turkey, and Russia, these, you can call them emerging markets, you can call them secondary, whatever you want to call them. US is at that level now. We're no longer on top in terms of the size of our middle class. The middle class has been eroded. And that's because of all the things that I've been showing you for years in terms of how healthy is the economy and how much money are people making. Another interesting thing, again, from Zero Hedge, this is going to be the last news report, and then I'm going to get into the gold and silver report. We'll do that here in a moment. But I wanted to highlight this. U.S. mall values crashed by a record 60% in 2020. Now, this is something I predicted for the last 2 to 3 years. I used to write for Seeking Alpha, a really big site where a lot of people write on finance. And a lot of accredited investors go to get investment data. I think there's something like 20 million visitors every month, 6 million registered subscribers at Seeking Alpha. The average registered subscriber makes $377,000. At least that's what it was last year. I don't know what the 2021 data is, but as of 2020, people that read at Seeking Alpha basically are all, rich and accredited investors, top 1%. And so I used to write there, and I kept saying the REIT sector and the retail real estate sector is in trouble. And you're starting to see it. Now, I'm always ahead of the curve when I say this because I look at data and I can start to see trends in data before they blow up into big trends. I see them when small trends, and I look at the overall economy. I look at a lot of things, and I called this. And so US small values crashed by 60% in 2020. So all of those REITs, those real estate investment trusts, those funds that you can invest in real estate that have a mall component, you can expect that those will continue to fall. Now, I've stated before that REITs can fudge their numbers. There are creative ways that they can fudge their accounting, but they can only do it for so long. Expect these numbers to start to hit the returns on the REITs any day now. In fact, they've already started to, but they're really going to hit big time in 2021. For those of you that subscribe to my website, the paid subscription, the Q1 newsletter, which I wrote at the end of January, this is about a month and maybe 6 or 7 days ago, I said the big story of 2021 is going to be the crash in real estate. And I highlighted this stuff for my subscribers about a month before I'm bringing it to you guys on the YouTube channel. So that's one reason you may want to subscribe to me on the website, because I'll get to things. I'll do my predictions, my early predictions ahead of when I release them publicly. And it's one of the outstanding predictions I made 3 years ago. I think this one was in 2017, 2018. You can see that on my website. You can go to the research page and it'll show my predictions. And I link where I made the prediction so you can follow where I actually have been credited for making it. It's either 2017 or 2018. I said one of my predictions was a real estate crash. And that's about to come true, I think, and that's going to happen in 2021. I think that's starting now. So in any case, the mall values crashed by 60%. I'm not going to go over detail on this, but you can read it. Here's one. I'm just going to pick a random quote. We're just going to read one thing, but you guys can go and read this report on Zero Hedge. Simon's Town Center at Cobb outside Atlanta, which once appraised $322 million, received no bids at a courthouse foreclosure auction in February, meaning nobody wanted this bad boy. According to a local news report, the company's Montgomery Mall near Philadelphia was appraised at $61 million last year, a 69% drop from its 2014 value. So you can see how these REITs, based upon these malls or that have a large mall component, are going to continue to crash. When you literally can take a foreclosure sale and there are zero bids on an entire mall complex that was valued almost $400 million at one point, I mean, that's tremendous. That shows you what the investors are smart. They're not buying something that's on the decline, going to keep declining, even if they get it at a discount, because they know people aren't shopping at malls anymore. They're ordering online. And overall sales, even though the amount of online sales has increased, overall retail sales has fallen. And I wrote an article about that basically for the last year. I believe that was on Seeking Alpha and on my website as well. You can go look in the free section of my website and find that report where I said, if you add up the increases in online sales, it still does not equal the decreases in the brick and mortar sales. So overall consumer spending has been going down. Of course, I just showed you that with the reports, the previous reports on Zero Hedge as well. All right, next, we're going to go into the metals report, what you all have been waiting for. So here is silver. You get adjusted here so we can do this one. Silver has had some pretty good deliveries. I covered this, the first delivery day of March was actually back in February. So this is last week I covered this. And I talked about how we had healthy deliveries. And I want to focus on that too. So let's go back to that Friday, February 6th. We had 5,904 contracts of 5,000 ounce silver. It's about, what is it? 30 million ounces. That's quite a bit. We also had strong EP numbers. That's people going over to get exposure in the London market. Either they're taking delivery or they're getting some sort of paper derivative exposure because the OTC market is unallocated. But there's a lot of that too. So we saw 9,000 contracts between London and COMEX of 5,000 ounce silver on the first intent day for March, which occurs 2 trading days before the beginning of the month, 2 business days. Then in Monday's numbers, we still saw 916 deliveries and 478 EFP here. And then if you go to yesterday's data, you saw 772 deliveries on COMEX and 1,031, either deliveries or access to the unallocated OTC BS market in London. And so we're seeing lots of interest in silver is what that means, increasing interest in silver. If you want to look at the price trend, silver's remained fairly strong. Right now it's in the 26 range. And you can see overall that people are trading at about 26 and a half, a little less than 26 and a half, 26.385, somewhere in that range. 26 and what is that, 3/8, give or take, contracts for May. So a lot of the trading has shifted to May, and it looks like we're sitting in that 26 area. But again, that's all paper. It has nothing to do with physical, because physical is running out just about everywhere. It's run out in the retail sector. Some people still have 1,000-ounce bars, not a whole lot. Obviously, there are still some 1,000-ounce bars on COMEX because people are doing the 5,000-ounce contracts at a fairly heavy rate to the tune of about 30 million ounces, plus an additional how many million ounces are going over to the London market as well. So there is some liquidity in silver, although it seems to be tightening up. It started in retail. And it's not just because mints closed and things like that, because a lot of them have reopened. It's because the current prices are cheap. People see risk in the system. They're taking delivery because silver is cheaper than gold. So you have more people able to do it. And you also have the industrial demand, and there is a temporary shortage in silver. Will that lead to a long-term shortage in silver? We think so, because according to Silver Institute, we're supposed to increase industrial silver demand by 100 million ounces to over 1 billion ounces this year, at the same time in which we don't have a lot of free silver, and the investment demand has gone off the charts. We talked about that repeatedly on previous shows and have talked to Andy Shankman of Miles Franklin and James Anderson of SD Bullion about that. So we know that silver is not readily available to the retail market, and there are shortages. Okay, moving over to gold. Gold got smashed. I'm going to talk about gold getting smashed here in a minute on February 25th. Of course, you see this big volume bar in both the futures and the options. And I'm going to show you that's when gold got smashed down into the low 1700s. It's very clear in the charts. It's unmistakable. It's a fact. It's on COMEX. It's their data. Not conspiracy theory. It is a fact. This is how the market trades. I'll show you that in a minute. The big thing about gold was there had been a healthy amount of deliveries as well. So on the first delivery day for March in gold, there were 2,531 on the March contract. There were 7,013 on the EFPs. So 7,013 went over to London. You look on the deliveries, the next delivery day, which was this past Monday, 823, and then almost 2,000 in London. So you can see more gold demand pushing over to London, that unallocated market. What does that mean? Unallocated means not one owner. It means you're going to have more paper sitting on top of less metal. That's literally the definition of unallocated. More traders than there is actual metal, or more paper claims or speculation on top of actual metal. You're seeing more gold going to that unallocated market than you're seeing delivered on COMEX. If gold was really that liquid on COMEX, people would just take it off COMEX, because all you got to do is switch the warehouse receipt to that gold. Doesn't have to move anywhere, and you just hold it right there. It's not that expensive to do one of these things. You just basically have to be willing to pay, all of the margin or 100% of the value of that gold. So what this tells me is people are interested in physical, either going to London or they're taking that derivative exposure, getting that short-term gold exposure, but more liquidity is in London right now than it is on the COMEX. In other words, it's more in the derivatives than it is the physical. That's the key. Now on Tuesday's data, same thing. About 5 times as much demand went into the unallocated OTC market in London than went on the actual deliveries. But even so, gold's had fairly robust deliveries. Let's get to the delivery report. You'll see that both gold and silver are having a very healthy delivery month in March. The first day, of course, we saw 2531 overall deliveries for March, and gold are sitting at 4947, this number right here. That's very, very healthy 4 days in what was considered a fairly light market for gold. In silver, we knew that there could be more deliveries because it's a fairly good amount of open interest. And you can see overall it's up to 7661. So the very first day it was at 30 million ounces. It's up more than that. It's up to 7661 contracts of 5,000 ounce silver. So it's creeping up. And if we get anywhere near the 16,000 of open interest, which we could, because we're only 4 days in. So we've got another, 20 calendar days, or was that 15, 17 business days in the COMEX markets we can take delivery, we could get to that 16,000 number. There were 16,000 contracts of open interest in silver when we started. So if you get all of that off, I think it's 80 million ounces. That would drain most, or the majority at least, of the registered silver stocks on COMEX. Registered meaning available for trading, not the eligible, the one that's privately owned, that's not registered for trading, but the registered. That would be the majority of that all in 1 month, meaning we continue to drain on the silver supplies. Much more demand we're seeing industrial and investment wise than there is supply coming in. That's why the numbers can continue to dwindle. Now, have we reached that clamp up phase in silver where it completely locks up because we have immutable silver shortages? No, but clearly the numbers indicate we're getting there. And I don't care what anybody says. There's been a lot of disinformation on a particular interview over at Kitco that people have been sending me. I'm going to examine that interview later. I'm not going to do it today. But essentially, a lot of what was said in that interview is balderdash and misinformation and misdirection. I'm going to show that. Won't do it today, but we will get to that. Fear not. All right, so I'm going to get back to something I teased earlier. Look at the smash down that occurred on February 26th in gold. Let's go over to the settlement numbers. The volume is how many contracts are trading futures and options. The settlement tells you what the average price is and on what month. So the active month being traded in gold right now is April. You can see by the amount of volume of the open interest. So at an average price of 1750.80, there were 235,000 contracts that sold. That was on Wednesday. If we go back to Thursday, February 25th, we were trading in the high 1700s, 1775, 300,000 contracts. Then if we go to the next trading day, Friday, February 26th, this is where it happened. 364,000 contracts. Look at that spike in volume closing at 1728. That's a $50 difference in one day. So when you see a spike in volume on this chart, I'm going to teach you guys how to do this. When you see a spike in volume on this chart, the immediate thing you should do is for that day, go to settlements and see what the price is compared to the previous day. So let's go back and let's look at that again. We're going to go to settlements. We're going to look at the price. So if we looked at the 25th, there was a healthy 317,000 contracts, but in the high 1700s. Then the paper shorts came in. The naked shorts, by definition, a naked short is when you don't have the metal to back each contract position that is settling. That is by definition a naked short in any market. Okay, there were not 364,000 contracts of 100-ounce gold backed by metal because there's not that much gold there available in the registered category. So it can't be, it's naked shorting. They dropped it $50 in a day. That's how it works. So people that say, oh, the futures market, normal trading market, it's all normal. And the price is determined based on, individual trader wants, and that accurately reflects the physical market in gold, silver, or any other commodity. It's not how it works. There's a bunch of paper not tied to any physical ounce that settled $50 lower just because people wanted to come in and dump paper on the market and do that. These contracts were not tied to physical. They are by definition not deliveries. How do we know? Because the deliveries are reported separately on the report. So there's 364,000 contracts on Friday, February 26, 364,000 paper, and only 2531 physical, okay? 364,000 paper, 2531 physical. Over 100 and some times paper over physical. In other words, there's over 100 times paper claims on physical gold than there is gold being traded on these markets. And that's called a smash down. And that's not conspiracy theory. That's straight off the numbers on the website. Undeniable proof. That's exactly how the market trades. These settlements have nothing to do with physical. So when people say, oh, that's the price of gold on COMEX, that reflects the interest in gold. No, it does not. That reflects the interest in paper derivative that has very little to do percentage-wise with gold because you have 364,000 compared to 2,000. You see the difference? Now, if it were 5,000 compared to 2,000, I would say the paper contracts at least were based 40% on real gold. They have some semblance, not a majority of, but some semblance. No, it's less than 1/100th. In fact, it's probably about 1/130th. The two are not the same. So when people quote the gold price to you and they're not looking at settlement data and they're not relating that to actual physical gold trade, they're not talking about the gold market. They're talking about some Ponzi paper system, which you might as well go into a casino in Rio or in Vegas or in Atlantic City because it has nothing to do with gold, okay? It's not even 1% real gold, not even 1%. That is a fact in the numbers I just showed you, an undeniable, indisputable fact. Now, there have been people going on certain shows talking about, oh, this is the real gold market. This is a real silver market. No, ladies and gentlemen. Look at the volumes of paper compared to the volumes of physical. and look at how much additional paper goes to the unallocated derivative OTC market in London, especially in gold, than has been going into actual physical gold on the COMEX. There you go. So it has nothing to do with gold or silver itself. When we're talking about the actual physical metals you can hold in your hand, you can use in products, you can store in your safe, you can store overseas, you can put into medical devices or computers or cars or whatnot. The two are completely different. And that is an undeniable, irrefutable fact based upon the numbers I showed you. So to recap today's video, the shutdowns are causing major issues. The governors in Missouri and Texas are getting flack for opening up. But if you look at the numbers like I did, they realize they have to, or it could crash the system. And once a sizable bank goes down anywhere, because all the banks are intertwined with their credit systems and the currency systems and the loans, the whole thing is going to go poof across the world. It's going to be a domino effect. You cannot separate Texas and Missouri from the rest of the United States. You cannot separate the United States banking system from the rest of the world. It doesn't work that way anymore. This is not 1905. This is 2021. It's a different system. It's globalized, intertwined system. Once any banks start going down, that could cause a ripple effect if those are big enough to the rest of the banking system. We also know that personal expenditures are going down. Saving rates briefly spiked, but that was from government money. So in other words, it comes from taxes. So it's robbing from one to give to the other. That's not a sustainable way to grow the economy by definition, especially when you add in the cost of transferring or the cost of government, meaning that you're not going to get a one for one. It's not like I'm giving $1 to my neighbor and he's able to spend $1. I'm giving $1 to government. They take their 20-30% inefficiency out, and the next guy's getting 60 to 70%, and it goes down a black hole, and they still haven't solved their problem. And you see that in the delinquency rates, the very first report I showed from TransUnion. And the only thing that hasn't been affected so far is mortgage rates. But remember the Basel III requirements, the liquidity ratios, and the rising mortgage rates. You're going to start to see that in 2021. That's going to change on the mortgage rates. Autos, unsecured loans, and bank cards have been hit. Those are the babies. The big one, the nuclear bomb of the banking system, the mortgages, you're going to see that. That's the big one, at least from a consumer perspective. You're going to see that start to break up in 2021 based upon the data I showed you. So that's going to be today's video, guys. Thank you so much. Leave your questions down in the comment section. I'll try to answer as many as I can. Until next time, this is Rob Keents, goldsilverpros.com.